Investing in the S&P 500 is pretty easily one of the most popular forms of investing advice you'll come across online. After all, it's an index of the top 500 companies in the United States, so a lot of people view it as a very easy way to diversify your money and get exposure to some of the strongest companies in what's historically been one of the strongest stock markets in the world, with even Warren Buffett himself encouraging investors to just stick their money into an S&P 500 index fund.
Buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through...
If anyone followed that advice, it's worked out pretty nicely for them. Over the last 50 years, the S&P 500 has seen an average total annual return, so inclusive of dividends, of 11.1%, which is pretty good, and actually outperforms the majority of equity-based actively managed funds. But as you might have heard, there's been some growing murmuring over the integrity of the S&P 500 and whether it's still a diversified investment you see, given how well this simple strategy has worked out over the years. We've seen a lot of money start tracking the index, with there being $7.1 trillion directly linked to the S&P 500. As of 2021 year-end, which is actually double the amount it was 3 years prior. And that's led to the concern that all this money flowing into these index products is inflating the value of its constituents, namely for the largest companies by market capitalization, which increases the risk of concentration that just a handful of positions will dominate the performance of the overall index. For example, last year a group dubbed the Magnificent Seven, which includes Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla alone, accounted for roughly 2/3 of the entire index's return for the year, which you can really see the impact of when you graph the performance of the S&P 500 excluding these 7 positions. Now, this is far from the first time we've seen alarm bells rung over the S&P 500 and even in index investing as a whole, with a lot of active investors criticizing the practice for impacting price discovery, with the idea being that if all these investors is $7 trillion of money is just being parked into these companies without any real fundamental research, it's going to lead those positions to become inflated and could contribute to a bubble, given that we aren't seeing buying and selling activity based on the company's fundamentals or research into the business, with one paper in 2016 even claiming that index investing was worse than Marxism, which is a pretty alarming claim. But it's always been important to take this alarm's commentary with a grain of salt, given not only that the S&P 500 has continued to perform well over the long term, but also that active investors have a very clear conflict of interest here, which is that index funds have actually taken away a lot of their business given their cheaper fund structure. So of course an active fund manager who's losing business is going to claim that their competitor represents the end of capitalism as we know it.